General Motors restructuring. General Motors, GM, has announced plans to eliminate approximately 14,000 jobs and close 5 manufacturing facilities in the United States. This restructuring represents one of the largest workforce reductions in the company's recent history and contradicts the administration's assertions that protectionist trade policies would preserve American manufacturing jobs, rather than maintaining an exclusively domestic focus as advocated by the America First policy. GM has implemented a global strategy with significant investments in international markets. The company has invested approximately $20 billion in electric vehicle research and development, generated over $32 billion in revenue from international markets in 2024, and expanded production capacity overseas, with approximately 40% of products now manufactured outside the U.S. GM has allocated $1 billion for factory expansions in China and India and committed $5 billion to establish electric vehicle manufacturing facilities in Mexico. This strategic reorientation demonstrates GM's prioritization of global competitiveness and future technologies over domestic-only production models. Subscribe to our channel for more in-depth analysis on automotive industry trends and economic policies. Automotive tariff implementation and effects. The administration has implemented a 25% tariff on imported vehicles and components, including those from traditional trading partners such as Canada and Mexico. An even higher 200% tariff has been proposed for certain imports. According to multiple industry sources, the implementation of these tariffs has resulted in initial automotive stock declines. GM reportedly experienced a 3% drop before recovering. Production relocation decisions by multiple manufacturers, and shifts by companies like Hyundai, Toyota, and Nissan to move production outside the U.S. to avoid tariff impacts. Toyota and Honda have reportedly redirected planned U.S. investments, estimated at $10 billion, to facilities in Mexico. Industry analysts project significant price increases for consumers, with SP Global Mobility estimating that a vehicle with a base price of $25,000 could see production costs rise by $6,250 under the new tariff structure. The Anderson Economic Group forecasts that the 25% import tariff could increase vehicle prices by $5,000 to $15,000, depending on foreign component content. Specific EV models already show price increases, with the Tesla Model Y long-range AWD now priced at approximately $51,000, up from $47,990, and the Ford Mustang Mach-E at $45,000 to $47,000, a $2,000 to $3,500 increase from 2024 pricing. Supply chain disruptions. The North American automotive supply chain has developed as an integrated system, with components frequently crossing borders multiple times during production. According to SP Global Mobility, a single vehicle may cross the US-Canada border 6 to 7 times before final assembly, with each crossing now potentially subject to tariffs. Even ostensibly American vehicles contain significant international content. The Ford F-150, despite being assembled in the US, contains up to 30,000 parts produced in more than 24 different countries. Critical components are often sourced internationally, including alternators from Mexico, wheels from South Korea, and drive shafts from Canada. Tesla relies on approximately 25% of components from Mexico and another 10% from other non-US sources. The tariff implementation poses particular challenges for smaller suppliers, as approximately 80% of automotive suppliers have fewer than 50 employees. These businesses typically lack the capital reserves to absorb sudden cost increases, and production disruptions can occur when even a single component is unavailable. Employment impact and economic consequences. The automotive sector is experiencing significant workforce reductions, including GM's announced elimination of 14,000 positions and Stellantis, parent company of Chrysler, Jeep, and others, temporarily laying off nearly 900 workers across 5 U.S. plants. There have been production suspensions at Stellantis facilities in Windsor, Ontario, and at its Tuca plant in Mexico. Projections suggest up to 50,000 automotive workers could lose their jobs in 2025. These job losses are concentrated in regions with high dependence on automotive manufacturing, such as Michigan, Ohio, Tennessee, and Ontario, Canada, for cross-border operations. Reports indicate that the tariff announcements triggered substantial market volatility, with claims of $6.4 trillion in market capitalization losses following tariff announcements, retaliatory tariff threats from trading partners, particularly Canada, and potential inflationary pressure on consumer goods beyond the automotive sector. Strategic industry responses. several manufacturers are reportedly re-evaluating EV investment plans. Ford Motor Company has delayed the launch of a new three-row electric SUV in Canada and postponed development of its next-generation electric pickup in Tennessee. Rivian Automotive has suspended a planned multi-billion-dollar factory project in Georgia. Canada has begun pursuing alternative strategic partnerships, including a preliminary agreement with the European Union on clean battery standards, ongoing EV cooperation discussions with Australia and South Korea, and expanded trade agreements with France, Germany, and Mexico through an extended CPTPP framework. While North American manufacturers adjust to the new tariff environment, international competition is intensifying. China has emerged as the world's largest automobile exporter. Chinese manufacturer BYD has expanded in Europe with its premium Denza brand, and European manufacturers continue to advance EV development. The Organization for Economic Cooperation and Development, OECD, projects that if current tariffs persist through late 2025, average production costs for EVs in North America could increase by 8 to 12%. 185 economies globally may experience indirect effects from escalating trade tensions, and investment flows and sourcing networks are being re-evaluated. Political and diplomatic context. The tariff implementation has generated diplomatic tensions, with the Canadian Prime Minister threatening retaliatory measures and the European Union announcing plans for potential 25% retaliatory tariffs on U.S. goods. There have been reported tensions with France, including an incident involving statements about the Statue of Liberty. White House communications have maintained that the tariffs will benefit American manufacturing, despite industry objections. The American Automotive Policy Council has reportedly stated that tariffs are increasing costs for the industry, but administrative spokespersons have continued to defend the policy. The evidence suggests that the implementation of automotive tariffs has generated significant disruption in the U.S. automotive industry without achieving the stated objective of preserving domestic manufacturing jobs. Instead, the policy appears to have accelerated production relocation, increased consumer costs, and complicated North American supply chains. Global manufacturers are adapting to the new trade environment through production relocation and strategic partnerships that often bypass U.S. facilities. Meanwhile, China is strengthening its position in the global automotive market, particularly in electric vehicles.